I'm going to start this week by talking to you about two flips. The first flip has been in the S&P 500. In the second half of February, the S&P 500 was up about 4%. Today, it's down about 4%. Now, in order to kind of understand what went on there, let's divide that into two bits. The first bit is, why was it going up first? Well, it was going up first because U.S. companies were reporting extraordinarily strong fourth quarter earnings during Feb. Now, it doesn't always work like that strong earnings reporting makes the market go up. But there really wasn't a lot of bad news in Feb to drag down the market, and the earnings really were great. At the December 31st, the FactSet said that analysts were predicting about 10 or 11% earnings growth for the fourth quarter. As it turned out, after all those earnings were actually reported, earnings growth is about 18%. 18 is high basis the history of earnings reporting, and of course it's very high. It's a very high beat of analyst forecasts. So you had all that good news from earnings, and I think that's why the market kind of was up 4%. But the good news ended. Companies reported their earnings, and that left the market vulnerable to bad news. And now that we're talking about the bad news, we'll go to the second flip. If you go back in February, the Atlanta Fed GDP Now calculator was estimating that the U.S. economy was growing in the first quarter of 2025 at 2%, actually a little higher than 2%. Today, the Atlanta Fed GDP Now calculator is saying that the U.S. economy is contracting at a 2% rate. That's a pretty dramatic shift in the estimates. Now, the calculator is just a reflection of data as it comes out. So basically what that's saying is that the data that has been coming out about the U.S. economy, in the latter part of February and during March, has not been very positive. And the really key pieces of data have been related to consumer spending, that the U.S. consumer appears to be nervous about the future, and he's not spending as much. And since consumption is such a large part of the economy, that really makes GDP take a hit. So without the backdrop of very strong earnings, the market was very vulnerable to a decline. And if you really believe that the U.S. economy was shrinking at a 2% rate, the fact that the market is only down 4% year to date, that's actually a pretty good result. You would think it would be worse. Now, the second topic I'm going to go to is two pieces of good news. And the first piece of good news is it's very unlikely that the U.S. economy is shrinking at a 2% rate. One of the things, or one of the quirks of the Atlanta Fed GDP Now calculator, it does not adjust for non-monetary imports of gold. And because of Trump's tariffs, gold traders or commodity traders, hedge traders, have been very eager to ship gold from Europe or other places to the United States and then leave their hedges, the short hedges that hold their long positions, overseas. And if tariffs are put on gold, presumably the price of gold would become higher than the price of gold overseas, and they would get a big profit by being long gold in the United States and short gold elsewhere. So there's been a huge amount of gold shifted to the United States. And although the BEA, the Bureau of Economic Analysis, that calculates the actual GDP, will adjust for that non-monetary imports of gold, the The Atlanta Fed GDP Now calculator does not. So when the Atlanta calculator today says that the economy is shrinking at negative 1.8%, in reality, when you put in the adjustment for the gold, it's probably growing at a 0.4% rate. So 0.4% isn't too good compared to the 2.3% growth rate we had in the fourth quarter of last year, but it isn't as bad as shrinking at a 2% rate either. So that's good news. The second big piece of good news is, I think, in another 20 days, US companies are going to start reporting earnings again, and I think they're going to beat on analyst estimates once again. Now, that's something I'm not necessarily in position to make a strong opinion of, but what I think is going on is that the analysts are being influenced by all the volatility in the market, and they've been writing down their estimates and reducing their estimates for first quarter earnings much more quickly than they normally do. Right now, they're showing earnings at 7% year on year, which is not bad, but relative to what we had in the fourth quarter, that's not so great. But I expect that when the actual earnings come out, they'll find that they allowed the market to make them too pessimistic, and the companies will beat on earnings quite significantly, and we'll see the market react very positively to that. So those are the two pieces of good news. If you want to say what's the dark cloud behind the second piece of good news, is that we have to wait 20 days or so before they start reporting earnings. And lately the market's been volatile, and we can expect the volatility to continue. And that comes to the last kind of double that I'm going to talk about, which is the Fed meeting tonight. And in the Fed meeting, we have reasons that it might create a double dose of volatility. Now, why do I say that? Well, simply the market's already volatile as it is. And Fed meeting days often create a lot of volatility in the market. So if the Fed's got to be speaking tonight when the market's already volatile, if there's any surprises from the Fed, we could have a very volatile day tonight. Will the Fed necessarily say anything that will upset the market, or on the other hand, exceedingly please the market? To be honest, I don't think so. I think the goal of the Fed, or the most probable thing, is they'll say very moderate things. The Fed won't be able to say that the US economy is doing just fine, because there's too much information that's slowing down. So they'll have to acknowledge the economy is slowing down. In fact, if they sound too positive on the economy, the market won't like that, because they'll think, well, the Fed is kind of preparing us that they're not going to cut rates going forward because the economy's strong, and it'll drop a lot. So they'll acknowledge the economy is not doing so well, but of course they're not going to say anything like that they're overly concerned that we're going to go into a recession anytime soon. It'll be a moderate statement. And their statement on inflation has already been kind of moderate. They say interest rates are already high enough to bring down inflation. They believe inflation is dropping, and it's just a matter of time before it declines to below their 2% target. So the Fed will try not to say anything to give the market a shot, but you never know. Historically, Fed meetings create volatility. We're in a volatile market. It wouldn't be surprising to see the market jump around quite a bit this evening. Thank you very much.